Hello, my name's Ethan. Make sure to check out my website, ethanwrenn.com. From there, you can find links to all my various socials. I also have a blog. I'd really appreciate it if you guys go and check that out, as well as an online store where you can buy hats, shirts, hoodies, stickers, all this great stuff. So I'd really appreciate it if you guys would show support. And as you can see, this is an example of what one of my blog posts may look like. If you just come to my website at the top, click blog, and you'll find a bunch of different articles. Click whichever one you seem to fancy. This is the Vanguard Total Stock Market ETF, and as you can see, it just has a bunch of different information pertaining to the product, as well as their top holdings. And every blog post also has its own unique video, and you guys are able to leave comments and let me know the feedback and how I can improve. So the video we're going to be jumping into today is how interest rates impact the housing market from the IMF. Yeah, the IMF, guys.
So, you want to buy your first home. House prices have started going down in many countries, and that may seem like a good news.
Also, before we even get started, right? This video was uploaded 3 months ago, so contextually, we covered a lot of real estate investments in today's stream, whether it be XLRE, DRN, ARE, and we explained how there's this great opportunity to be scaling into some of these real estate investments, things that are going to benefit from a decreasing rate environment. But also, I want you guys to keep that in perspective with the tone that he's using in the video, because he's having gone through all of 2022 with the aggressively rising interest rates that have driven down a lot of these real estate investments. But again, presenting that great opportunity. We need to recognize we are now in a near peaking rate environment, and we need to allocate our money accordingly into investments that are going to benefit from an entry into a decreasing rate environment. So yes, we've covered a lot of real estate investments today, and he's going to, again, 3 months ago, he made this video. Just
but
for
the reality
context.
is a bit different, because a decline in prices doesn't necessarily mean that buying a house is more affordable. Let me explain. House prices are driven by a variety of factors, but the key one is the mortgage rate, which reflects the cost of borrowing money to buy a house. And the mortgage rate is largely determined by the policy interest rate set by the central bank.
Keep in mind, whenever you're buying a home, you need a mortgage, or you're investing, whether you're buying the home personally or it's a company who's trying to invest in real estate for building an apartment complex, building a shopping center where he's going to lease out to different retailers. Maybe he's a storage unit facility. They all need a mortgage, and there's two types. You need two common types. We have a floating rate mortgage and we have a fixed rate mortgage. When you enter into a fixed rate mortgage, that policy is locked. But if you enter into a floating rate mortgage, depending on where rates are going, every time you pay your bill, it's going to be adjusted based on that current rate. So if rates are currently high and you're in a floating rate mortgage paying 4, 5, 6%, I'm just saying a random number, and rates start to come down, you're going to see the immediate effects of that in your floating rate mortgage payments, as you're now paying, I don't know, 2, 3, 4, it's going to come down. And you're going to see that in your payments in real time, and that's going to directly turn, that saved money is going to reflect on a positive ROI, or a more positive ROI.
And the driving force behind all of this is inflation. If inflation is more than where the central banks wants it to be, then it may raise the policy rate to make it more expensive for banks to borrow money from it. This will likely push up mortgage rates as banks pass on their higher borrowing costs to home buyers, especially when the interest rate on the mortgage is variable and can change depending on market conditions. Typically, when mortgage rates go up, the demand for houses go down, leading to lower house prices.
On top of that, that's one aspect I even covered less so in the product-focused videos we did earlier, but not only are real estate companies going to benefit from a decrease in rates, allowing them to get easier access to capital, but when rates come down, regardless people across the world, whether it be, again, be personal people or companies, have equally access to, they equally gain access to this capital, right? Which then creates more demand for these assets, which then further drives up the price of things like real estate. So when rates come down, you see an increase in demand for real estate or just borrowing money in general, investments, anything.
But it may take time for prices to go down depending on the availability and demand for housing, which might be sustained due to changes in consumer preferences, for example, toward teleworking. In fact, when interest rates are high and supply is constrained, it may be more affordable to continue renting than to buy a property. And this could keep pressures on rental costs until overall prices adjust. What is important is that the rate of decline for houses isn't more than the economy can absorb, because the housing market is strongly connected to also other parts of the economy. This means that a sharp decline in house prices could have a wider impact on the economy through different channels. First, when housing prices are lower, the wealth of homeowners is reduced. This could lead to lower consumer spending and economic growth. Second, a sharp drop in house prices can affect construction, worsening the economic.
Again, we already covered symbol XLRE in today's stream. There's going to be a highlight on my YouTube channel. I highly recommend going to watch it, and it'll show you the current state of real estate. 2022 was an abysmal year, but what did it do? It presented a great opportunity to be scaling into some of the most high quality companies that the market currently has to offer. Companies that produce profit margins between 35 and 50% and pay huge dividends like 4.1%. Like, these are excellent companies that are representing the real estate markets here in the US. And again, they're already at the bottom. They already went through it. Like, we're talking past tense. This video is already 3 months old. We're talking past tense. It already went through it. Now that it's when these things are down in the dumps that you really need to potentially consider scaling into these different investments. We did the same thing with tech. Tech's doing amazing. We did the same thing with banks. Banks are doing amazing. Real estate, let's go.
Slow down. Finally, lower house prices and economic activity could also increase the probability of default on existing loans. This could undermine the stability of financial institutions, making them less willing to extend new loans and further impacting investment and consumption. The impact of lower house prices is then likely to be larger if house prices are overvalued or if households are more indebted when the interest rates change. To mitigate then the risk from a decline in house prices, policymakers should monitor the housing market and take timely and targeted steps to limit the vulnerabilities in the sector. This could include the tools that restrict demand for riskier loans when house prices are rising, or policy measures aimed at ensuring adequate capital of financial institutions. Finally, efforts to boost affordable housing and reduce speculation through improved property taxation are also important steps to mitigate house price pressures and protect against future large price declines.
So that was a great video. I'm not sure if you guys are even familiar with the IMF. The IMF is the International Monetary Fund, is an organization governed by, like, they're pretty big channel here. Maybe if I click on them, let's see. But they produce a lot of very important financial information in general, and they cover the United States, I think all over the world, really, especially when it comes to like currencies and things like this. But that was a pretty good video. The one takeaway you guys need to understand is throughout all of 2022, the Fed has been aggressively increasing rates. You should think of rates as like a cycle, right? You know, rates have been going up, and inversely throughout all of 22, things such as real estate have had this massive pullback. But you can say that about almost all markets, and you're starting to see a lot of those markets turn around now with a lot of sectors really starting to outperform and set new highs. You have European nations, major market indexes setting new all-time highs this year, the past couple months. So that we're definitely seeing this bottom forming. But now that, again, rates have been increasing, and they're nearing a peak in their cycle. Rates are starting to peak. You have every major media outlet projecting that the Fed is going to either start pause. The Fed is going to stop increasing. They're going to potentially enter a pause period and then lead into a decreasing rate period. So, knowing that we are at the top of this rate cycle, you want to be positioning your money in a way that you're going to benefit from an environment where rates are decreasing moving forward. Again, whether it peaks last month or whether it peaks 3 months from now, that's all within margin of error of a prolonged multi-year decreasing rate period. Again, real estate is one sector that will massively benefit from this. And you just need to keep in mind contextually that real estate has pulled back for the past year. It is at a low, an objective low, and we covered that with symbol XLRE. There's a highlight on my channel. Definitely go check it out. And real estates are high, or rates are high, real estate's low. So we're going to see this switch, right? We're going to see the rates start to come down, but then real estate's going to start to run. So you need to position your capital accordingly. We're going to be moving into our next video.